Hey, welcome to the Mortgage Minute for January 31st, and my apologies. I haven't done any Mortgage Minutes in the new year. Got caught up with lots of stuff, but we're getting back on track. And, well, what else can I talk about? The big news is rates. It all started with Bank of Montreal coming out and saying that they're going to have a 5-year mortgage at 2.99%. And then, about a week or so, Ben Bernanke and the Fed said they're going to keep rates steady probably until 2014, meaning if the Americans aren't going to change, there's not going to be much expectation that the Bank of Canada and Mark Carney will change either. So, lots of talk about the... But I'll come back to the 2.99 BMO deal. But in today's newspaper... Sherry Cooper from Bank of Montreal said that it is really not a housing bubble, but more of a big balloon. Interesting comment she said is that it's unlikely that a sudden correction will take place. And furthermore, elevated evaluations, however, do imply a risk of material correction in the event of a shock. However, a shock is defined as if interest rates were to spike by about 4 percentage points. You know, keep in mind, 4 percentage point hike in interest rates is significant and certainly doesn't happen overnight, and certainly won't happen when Ben Bernanke in the United States and the Fed is expecting to keep rates steady until 2014. Therefore, it's not a bubble, it's more of a balloon. And again, the headline here says it all. Low rates may shield the housing market. Okay, so bottom line, it comes back to the rate. Two things that I always talk about is interest rates are kept low because of the global economic issues that we've been talking about ad infinitum forever, and those are not going away any day soon, so we don't expect any sharp rise in rates. Number two, when it comes to affordability is a huge component of affordability is consumer confidence. A huge component of consumer confidence is wondering whether or not you're going to have a job Monday morning. And right now, if we look at the Vancouver market and the Calgary market and the Toronto market, what I would suggest you do, if you're worried about these things, focus on consumer confidence. And that the key to focusing on consumer confidence is to focus on the employment numbers. Look for areas where there's steady, solid growth in employment, and you'll have consumer confidence and a steady, solid housing market. So, again, talking about the interest rates, Bank of Montreal came out with the 2.99 5-year rate. I'm going to give you guys a huge tip here. My recommendation is to take a 4-year term. We are currently in 2012, which is the year of a U.S. presidential election. Not always 100% true, but historically, in the year of a U.S. presidential election, rates tend to come down a little bit. And, well, look what we're seeing right now. So, in 2016 and 2017, neither you nor I really can predict what's going to happen. But here's my thought. If I'm going to roll the dice anyways and have my mortgage renew, I'd rather have my mortgage renew in the year of 2016 rather than 2017, because it just puts the odds in my favor that in the year of the next U.S. presidential election, we're more likely to have suppression of interest rates. So I would take a 4-year term, not a 5-year term right now. And on a final note, for those of you who haven't heard, I am actually going to go to Ottawa. I'm actually holding the first 5-year action plan live in Ontario in probably 4 years. So sorry I haven't been back there for all those of you in Ontario, and I am going to Ottawa February 18th. So that is the 5-year action plan live. Bottom line is you're going to find out spend a full day building a business plan, starting with where you're at today, where you see yourself in the future, identifying your obstacles, and then coming up with a 3-phase action plan for you to overcome your obstacles to accomplish your goal. That's February 18th in Ottawa. Details to follow. Folks, that's the Mortgage Minute for January 31st. Have a great February. We'll talk to you soon. Bye for now.